All right, ladies and gentlemen, I hope you had a wonderful day. It was an absolutely wild start to the week. It started off looking like we were going to rally and everything was going to be fine. And then by middle of the day, you did nothing. And then the end of the day, you started dumping. But the number one question of the day: did the AI bubble pop? So I thought we'd do this watch list a little different. We will start with the number one question of the stream, and that question today was about the AI stocks. Why were people asking this? Because NVDA was down 5%, Qualcomm was down 5%, SMCI went down 6%, and every single chip maker, I think except, even Intel ended up going down. Pretty much all of them, everybody except Apple ended up red. So the question was, did the AI bubble pop? You heard people on Bloomberg bring this up. A lot of people around the news were talking about this, and I will tell you right here, right now, because it relates to a major theme we're going to deal with, but not at all. There is no popping of the AI bubble, and if there is going to be, I would be looking out for earnings. Historically, if there has been any end to any bubble, whether we are talking 2001 or even think about the tech stocks after 2020, what caused the popping? It wasn't Powell and rates. Yeah, that gave you a little bit of volatility, but it has always been the earnings. And when the earnings and the guide downs and the expectations are sky high and the earnings come in down to the floor, that is where the bubbles pop, and that is where people rush to the exits. So yesterday or last week, that was the first negative week for NVIDIA in almost 3 weeks. We started off today with a little bit of that weakness, and people are talking about it, but I wouldn't get ahead of yourself. We have chip earnings this week, and over the next month, you are going to hear from some of the biggest companies, but that is what I would be paying attention for, the earnings, if you think the AI bubble is going to pop. If anything today, and to start off the week, you had people a little bit more cautious on how to keep valuing AI in the future because it's already went up so much. But one of the big things we've been talking about here, it's only been a couple of companies that have been killing it. It's already been a year or so where the names that are just bringing up AI in passing, if they're not making money off of it, it's not like those names are doing good supporting the entire stock market indexes. So hopefully this answers your question. It's the title of the video, but I am sure for the rest of the week we're going to hear a lot about this. And if we see NVIDIA and all these other chip stocks keep on selling off, you will hear the chorus get louder. But in my opinion, I think earnings is going to drive all of it. So hopefully you're riding with me on that. But that is the first thing of the day. I still have the keys. I have the plays, all that good stuff. What I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/the stock market. We will see you there in the morning, baby. Run it.
Couch, it's a 20 on the legs. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it.
But right off the bat, before we get into the keys, all you have to see is how we moved this morning. We got up to the highs of Friday. It was 54.78. Then it started taking off and going crazy. And we were talking about this because that is exactly what you saw happen last Friday. We got above that Powell level, and then you started the tear, and it looked like we were going to do that again, and then all of a sudden it came down, and then by Euro close, you didn't do much, held up, and then we started dumping. It's not like it was caused by data or anything else, and if anything, the last 2 weeks, even though the volume was low, we saw a little bit of a pickup, but today the volume was absolutely in the doldrums. I've been saying that a lot lately. So price action was all over the place. If anything, middle of the day, you did watch bonds inverse, and that was interesting to see the bonds end up green after starting off weak, and then the market ended up up lower, but once again, we had a weird dynamic. S&P was barely red on the day. NASDAQ dropped about 1%, but the Russell, although it's the same price it's been at for the last couple of months here since December, that was the leader, and then the Dow Jones did good. And really, NASDAQ down 1%, and how everything played out, it is just showing and highlighting how one stock, NVDA, had a pretty outsized effect. Again, 1% here, you actually had, I think, 60% of the NASDAQ going green for about like 80% of the day until we got into that close. So that's the quick market checkup as far as that goes. But now, as far as the keys, this is what I was just showing you. The concentration is back at it again. So it's a couple of names making the moves. If anything, you saw a lot more advancements on the equal weight. Even last week on Friday, the equal weight did good. But to start off the week, everybody's kind of cautious with this AI thing, and that chip slowdown, that gave us a choppy start. But now here's the thing you got to realize. I'm telling you, whether or not AI bubble pops or keeps going, that will be dependent on earnings. But subtly, a lot of people are not realizing earnings begins tomorrow. You're going to hear from FedEx, and then we're going to be hearing from Nike, and then Micron this week. You are starting earnings season, and although we're moving slow and don't have any big data up until Friday with the PCE, this is probably going to be the main driver here with earnings. So watch out for that. That is the first key. The second key, this was part of the morning, and I think this is something interesting that I would keep my eye on, especially with everything going on with the dollar, bonds, even the yen as well, but especially gold and rate cuts. You had some very interesting updates out of France today. A little bit of that volatility has been going back and forth, and if you don't understand the situation, here's what you got to understand. It's still going on. It's one day bad, one day good, one day bad, one day good. What's going on with France, their bonds, the spread, and even some of the European data, that is all big keys to watch because they could get us moving, or at the very least, start moving the dollar and a couple of other things. So that was the first big thing. And then China, they kind of got off to a good start, although there wasn't good data. Remember last week they were talking about weakening their currency and letting it fluctuate, or at least they finally let it fluctuate the first time in over a decade. But Xi Jinping, he came out saying he's going to support tech and a lot of other things today. If he actually does follow through, that will be huge. But any other time he's done it, he quickly came back with the hammer. But these were two big updates. I think it's word to the global tensions and global events being a driver. You did even have some updates from the Houthis all the way down to Israel, and even another war in Lebanon. And then there was one more thing. Oh, Russia and Ukraine. There was a bunch of attacks going back and forth. So that is still at play, and oil has rebounded a lot in the last 2 weeks since we've been talking about it being a cheap geopolitical hedge. So that is key number 2. Watch out for that. And the final thing, part of the day, and what we saw today and what you're going to be getting more over out throughout the week is the Fed speakers. There was a lot of them, or there's going to be a lot that speak today. We had 2 or 3 today, but even though they were saying a lot and some of it was hawkish, and then they come back talking about rate cuts, it is just not enough to move the needle. The path is still being followed. This is what we talked about yesterday. I brought this up a lot on stream. The market has made up its mind in a couple of Fed speakers here and there. It's not going to get you off of the path. If Powell in a dot plot isn't changing things, I don't know what people are expecting. You really need an external shock, or everyone's going to be waiting for earnings and everything to come into fruition. And then again, this is the year of the soft landing, or no landing. We'll see. But if anything, we still got a lot ahead of us. We'll see if that data changes by Friday. But for the most part, I hope you're ready for this summer trading session. And now, let us get into the plays. So, those are all of the main keys. We don't have much, but I can't stress it enough, man. Earnings is starting. So Nike, FedEx, and Micron, I made a play on all 3 of these today. Yeah, I know it's summer. I know it's quiet. I know I went to a lot of cash, but I like the earnings, and the options weren't that bad, or at the very least, considering how slow things have been, I thought it'd be a good idea to go for some of these earnings plays before they get hyped up. So I still kept it small, still use my 2 standard deviation strategy. If you actually go to the description of this video, how we price options, that is in there, so you could follow up and make sure you don't miss any of this, but I think it's going to be a big earnings week, and these companies, everything from consumer to shipping and now the chips, you're going to get a little bit of everything that could hopefully guide us here as we move forward. So watch out for those three. Those are going to be the main plays of the week. That is play number one. Then play number two, we talked about this last week, and I said keep in mind for earnings, and then we had those events with the FDIC. Well, you got rid of some of that event risk, and then today we had good news about banks lowering, or the Fed saying they might lower the bank reserve requirements. They all got a boost, and then you also have bank stress tests right around the corner. Again, the semi-annual ones. We're about to wrap up June here, 6 months in, so you will get an update, but the banks went from a couple of weeks of underperforming to now they are starting to ramp up, and no coinky-dink, it is happening right ahead of their earnings. So watch out for that. That is play number two. And then finally, I don't have a play on this, and don't go too crazy. But I would watch the bonds right now, and I would be waiting for a big short-term decline, not decline in yields, aka yields pop back up real quick, TLT comes down, and if it does make a nice little pullback, gives you one of those take out, Raul's, take out the floor, and then it'll probably bounce up from there. That will be a good time to get in for a swing trade, because like we talked about yesterday, if people are not pricing in a hard landing, a lot of these longer end bonds are looking pretty cheap. So keep this idea in mind, but we'll see where earnings takes us. I wouldn't force it, and the fact of the matter is bonds have already been on a rally alongside the oil when we've been saying that was cheap. So if it keeps going up, that cheapness, yeah, it may have existed for a little bit, but if it already gets priced back in, then unfortunately you'll just be taking on more risk. So don't go too crazy, but I'm keeping a short swing trade in mind for that. I have no plays on it currently, but those are the main plays. As far as everything else, I made some of those earnings plays today. So this morning, I started off with Nike. I went with an $85 put and a $110 call. I grabbed two of each. I bought the 85 put about 43 cents and then 62 cents for the 110. I bought more than one. So ideally, if we get some moves leading into tomorrow, I thought maybe it'd move today. I could make one of them free. So these are around 2 standard deviations. I eyeballed it real quick in the morning. Thought I'd go for it, but I won't lie, man. These plays were all expensive. Every earnings I looked at, even though it's kind of been quiet and liquidity is low, these options still got quite a pretty premium for some of these earnings, so be careful. But that was the first play I made. Then I grabbed a Micron weekly. I was looking at the next week plays, but they were too expensive, so I grabbed the weekly 100 put, and I don't think I'm going to hold this for earnings, but I do think it'll pop up here ahead, and if it doesn't move, then I'll hold it. I only spent $16, so it was cheap, get you some exposure, and then Micron has gone absolutely nuts in the last couple weeks, so we'll see if earnings gives us a surprise up or down. But that was the second play, and then I grabbed a FedEx next week 300 call for 75 cents. This one's just outside of 2 standard deviations. All the other plays were expensive, so I thought I'd go for it, and then I grabbed a weekly on accident, 295. I said, hey, I'll hold it, and then it popped up by the end of the day. Sold out, only made like $5 or so. So pretty much to sum it all up, I got Nike both ways, Micron cheap weekly to the downside, and then a FedEx next week to the upside for $75. So those were the main plays. I already went over the question, and big shout out to all of you guys asking the questions. And now let's get to the economic lesson. We've been talking about import substitution, why the countries resorted to it, how they started out, how they went from one system to the other, and the motivations. And now we're going to talk a little bit more about that, but like why? Protectionism worked for some of these guys, but then in reality, it also held them back. How did they come to realize that, and what direction did they start to go in? That is what we are going to be talking about today. So the structuralist critique, markets, trade, and economic development. Although protectionism reflected the interest of the politically influential importing competing manufacturing sector, it did not represent a coherent economic development strategy, and most governments were committed, at least rhetorically, to the adoption of policies that would promote economic development. Most governments wanted to shift resources out of agriculture production and into manufacturing industries because they believed that poverty resulted from too heavy a concentration on agriculture production. Higher standards of living could be achieved only through industrialization, and according to what was then the dominant branch of developmental economics called structuralism, the shift of resources from agriculture to manufacturing would not occur unless the state adopted policies to bring it about. The belief that the market would not promote industrialization provided the intellectual and theoretical justification for two central aspects of the development strategies adopted by most governments throughout much of the post-war era. That was a long sentence. Because structuralism played such an important role in shaping developing countries' trade and development policies, understanding the policies governments adopted require us to understand the structuralist critique. So if you're not understanding it from yesterday so far, remember this idea that these countries would focus a lot on agriculture and then the landowners, and then it changed throughout society, and then different political groups gained power. Right now we're talking about this idea of why countries wanted to shift from agriculture producing to manufacturing, and they thought too much of it with too much agriculture production would lead you to poverty versus better gains in development through manufacturing. So market imperfections in developing countries. Structuralists argued that market imperfections inside developing countries pose serious obstacles to the reallocation of resources from agriculture to manufacturing industries. Structuralists argued that markets would not bring about the necessary shift of resources because developing economies were too inflexible. Most important, according to the structuralists, was the belief that the market would not promote investment in manufacturing industries. The structuralists pointed to two coordination problems that would limit investment in manufacturing industries. The first problem, called complementary demand, arose in the initial transformation from an economy based largely on subsistence agriculture to a manufacturing economy. In an economy which few people earned a money wage, no simple manufacturing firm would be able to sell its products unless a large number of other manufacturing industries were started simultaneously. Suppose, for example, that 100 people are taken out of subsistence agriculture and paid a wage to manufacture shoes, whereas the rest of the population remains in non-wage agriculture. To whom will the new factory sell its shoes? The only workers earning money are those producing shoes, and these 100 workers are unlikely to purchase all of the shoes that they make. In order for the shoe factory to succeed, other factories employing other people must be created at the same time. Suppose instead that 500,000 workers are taken out of subsistence agriculture and simultaneously employed in a large number of factories producing a variety of different goods. Some make shoes, others make clothing, and still others produce refrigerators or process foods. With this larger number of wage earners, manufacturing enterprise can easily sell their goods. Shoe workers can buy refrigerators and clothes. Workers in the clothing factory can purchase shoes, and so on. Thus, a manufacturing enterprise will be successful only if many manufacturing industries began production simultaneously. So hopefully you're getting that. They're saying, yeah, you want to take your developing agriculture country, it's all farmers, you throw in one factory. I mean, yeah, they're going to make all of this stuff, but who is going to buy it if everybody is, or majority of society is still, around one economy and one wage? So that's what it's explaining here. I'm sure it's going to give you more. Structuralists doubted that unincorporated market behavior would produce simultaneous investment in multiple manufacturing industries. No single entrepreneur has an incentive to invest in a manufacturing enterprise unless he or she is certain that others will invest simultaneously in other industries. People willing to invest will thus wait until others invest, and as a consequence, no one will invest in manufacturing unless all potential investors could somehow coordinate their behavior to ensure that all will invest in manufacturing at the same time. The problem of complementary demand thus meant that if investments were left to the market, there would be little investments in manufacturing industries. The second coordination problem, called pecuniary external economies, arose from interdependencies among market processes. Think about the economic relationship between a steel plant and an automobile factory. Suppose that the owner of the steel factory invests to increase the amount of steel they could produce. As steel production increases, steel prices begin to fall. The automobile factory, which uses a lot of steel, begins to realize rising profits as the price of one of its most important inputs falls. These increasing profits in automobile industry could induce the owners of the car plant to invest to expand their own production capacity. Such a simultaneous expansion of steel and auto industries would raise national income. The two firms face a coordination problem, however. The owners of the steel plant will not increase steel production unless they are sure that the auto plant will increase car production. Yet the owners of the auto plant will not increase auto production unless they're certain that the steel producer will make the investments needed to expand steel output. Thus, unless investment decisions into steel and auto are coordinated, neither firm will invest to increase the amount it could produce. Once again, structuralists argued that the market market cannot be expected to solve this coordination problem. So again, the first problem, complementary demand. Yeah, you can make a new factory, but who's going to buy from there if the economy is still based on one thing? But then pecuniary external economies, it's talking about this coordination and how, yeah, these industries will work together with manufacturing, but at the same time, you know, they're kind of all feeding off of each other. And if one person doesn't coordinate or it's difficult to do, the structuralists are saying, well, this is why we can't switch to manufacturing in developing countries, and this is why it's a problem. So again, he'll finish explaining this, but the structuralist assertion that coordination problems would prevent investment in manufacturing was a serious problem for governments intent on industrialization. Fortunately, the structuralists offered a solution to the problem. Structuralists argued that the way to overcome these coordination problems was with a state-led big push. The state would engage in economic planning and either make necessary investments itself or help coordinate the investment of private economic actors. Thus, what the market could not bring about, the state could achieve through intervening in the economy. The structuralist critique of the market, therefore, provided a compelling theoretical justification for state-led strategies of industrialization. So think about that. I'm sure you could apply that. Or you tell me, pop quiz, where have you seen the big push, both recently and in the past? But continuing, market imperfections in the international economy. Structuralists also argued that international trade provided few benefits to developing countries. The argument was formulated during the 1950s, principally by Raul Prebisch. Raul? An Argentinian economist who worked for the United Nations Economic Commission for Latin America, ECLA. Hans Singer, an academic development economist. According to the Singer-Prebisch theory, participation in the gap-based trade system would actually make it harder for developing countries to industrialize by depriving them of critical resources. The Singer-Prebisch theory divides the world into two distinct blocks, the advanced industrialized core and the developing world periphery, and focuses on the terms of trade between them. The terms of trade relate to the price of a country's exports to the price of its imports. You should never forget this. This is going to come up a lot when we get into balance of payments. An improvement in a country's terms of trade means that the price of its exports is rising relative to the price of its imports, but a decline in the country's terms of trades mean that export prices are falling relative to its import prices. As a country's terms of trade improve, it can acquire a given amount of imports for a smaller quantity of exports. Thus, an improvement in the terms of trade makes a country richer, but a decline in terms of trade makes it poor. The Singer-Prebisch theory argues that developing countries' terms of trade deteriorate steadily over time. When they developed this theory, developing countries exported primary commodities and imported manufacturing goods. Singer and Prebisch argued that primary commodity prices steadily fell relative to manufactured good prices, thereby steadily reducing the incomes of developing countries. The periphery's terms of trade deteriorate according to this theory in the large part because of a result of differences in the income elasticity of demand for primary commodities versus industrial goods. So if you're not getting what he's saying here, essentially Singer-Prebisch, they argued that, yeah, well, as these countries trade and then you go and sell certain things to one country and then import what you need, these developing nations, you know, think about it, agriculture and commodities, well, as everybody in the other states kept buying more and more, they essentially, the prices come down, and over time, prices get lower and lower as demand goes up. They would end up being on the losing end because their terms of trade, they're now pretty much getting less in terms of their exports, and then they still have to buy the expensive imports. Continuing, the income elasticity of demand is to the degree a change in income alters demand for a particular product. For a product with low income elasticity of demand, a large increase in income produces little change in demand for the good. For a product with high income elasticity of demand, a small increase in the price of income produces a large change in demand for a particular good. Structuralists argued that the income elasticity of demand for primary commodities was quite low, but income elasticity of demand for manufactured goods was relatively high. Thus, as income rises in core countries, a smaller and smaller percentage of those countries' income will be spent on imports of primary commodities. But as incomes rise in the periphery countries, a larger percentage of those countries' incomes will be spent on manufactured imports from the core. Falling demand for primary commodities will cause the periphery country export prices to fall, whereas rising demand for manufactured goods will cause the periphery country's import prices to rise. Rising input prices relative to export yields deteriorating terms of trade. So that's pretty much what I explained to you if you're getting confused on anything. So most research disputes the claim that developing countries face a continuous decline in their terms of trade. That's Borsenstein in 94. See also Blochin Spapsford of 2000. Yet the objective validity of the Singer-Prebisch hypothesis is not the central consideration. What mattered was that governments in developing countries believed the hypothesis. Governments of developing countries were convinced that industrialization would not occur if they participated in the gap-based international trade system. This conviction played an important role in shifting the trade and development policies that developing countries adopted. So we're going to continue on the next one as we get into that tomorrow, but hopefully you're getting in. This is where a lot of theories, we're going to talk about perception a little bit, but remember, we talked about this in the beginning and even in the earlier chapters. The developing nations, they were very skeptical of the WTO, of the GATT-type system of trade and all this. They thought they would get taken advantage of. So there was all these hypotheses and theories leading into it, and it didn't matter if they could be contradicted or even if they were accurate, The fact was a lot of these countries believe this, and for, I want to say like 20, 30, 40 years, this identified and this created a lot of their trade policies because they were all skeptical of working to a certain degree, and this is where they were like, yeah, let's be protectionist because, well, why would we want to do that when we're going to end up losing in the long term? And eventually, you see nowadays it did change, but this was a big idea that shaped a lot of why countries were importing, going protectionist, or not. So hopefully you learned something new today. But Chatadonia, that is your watch list, ladies and gentlemen. Make sure you're healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, baby, not everything could come with you with where you're going, baby. Oh, yeah, you might have to leave some stuff behind. Grow and heal, baby. Oh, yeah. But Chatadonia, I love you. Drink that water. Stay hydrated. Stay healthy. All that good stuff. I'll see you in the AM end horn.